Now we're going to move into the double entry system, which talks about debits and credit procedures. As we start talking about debits and credits, it's a little bit different than how you think about them in regards to debit cards, credit cards, and how they react with your personal finances. They have a different meaning. It is a little bit difficult to really solidify and get this down pat, but once you do, you'll find that it is much easier to think about than plus or minus. So in an accounting information system, we don't really use the tabular format that we showed you for the analysis of transactions. What we use are accounts. And what accounts are is that they are an individual accounting record that records both the increase and the decreases of the specific asset, liability, or the stockholder's equity item. They have names. So, for example, cash, accounts receivable, accounts payable. One of the things to keep in mind is that when we are referring to a specific account, we will capitalize the name. In all reality, an account exists with three parts. And those three parts are the account name, or the title of the account, which you see right here. A left side of the account, or the debit side, and a right side of the account, or a credit side. This, in its simplest format, is actually referred to as a T account, because as you look at it here, you can see that it does look like a T. So before we go any farther, I'm going to show you how to set up a T account in Excel. So we'll start here, and I will merge and center this. This would be my account name. Cash, accounts receivable, salaries and wages payable, common stock, any account name. For visual sake, I will give this a bottom line. Then I will take some of these here, and I'm going to create the actual T. Put a left line in there, so that will separate my debit, which when we are abbreviating debit, we use DR. On the other side, the right side, it's credit. Regardless of what the account is, whether it's an asset, a liability, or owner's equity, it looks the same. Debit will be on the left, credit will be on the right. As we enter transactions, we'll enter it on the left or the right according to its effect on the account. Now, one of the ways that you can do this is you can take it to like the slide has it here, or we only have the balance. For working purposes and for your understanding, as we do these, what I will actually do is, and I'm just going to do what I call kind of like a subline. It's not a line that actually appears in accounting. And what it's going to do is it's going to take whatever is above it, and it's going to sum it. So then I don't have to do the math. I'm all for working smarter, not harder. But for the balance, go ahead and format those cells. That subline is not actually a real line in the T account. This is just a working line for us to use, for it to keep track of our math for us. So for this, you can do it a couple of different ways. We're going to do an if-then statement. And give me just a minute to open this wider so I can get to all of my tools. And we are going to do an if formula, which I believe is a logical formula. Yes. So our logical test is if this is greater than this, then we take this and we remove this. So we'll take the debits and remove the credits. If the value is false, it will be 0. We provide that same if-then statement. So we go back to our logical tests and say if credits are greater than debits, then we take credits minus debits, and if it's false, it's 0. Now, Excel is really only good as the formulas you put into it. So let's test this out. I have $150 in debits and $5 in credits. Then obviously you notice it works because we take 150 minus 5. Therefore, we would have 145. Let's just flip that. And it works. Remember, this subline that I put in here is only there so that way I can do my formulation without having to constantly check to see if I need to expand, if I need to add lines. We would have one of these for every account in the entire accounting information system. Stop and think about that extended tabular format we used earlier. Could you imagine trying to do that for hundreds of accounts? We only had like 8. We had hundreds like Microsoft or Google or any of the large organizations. It would be too bulky. This is a visual representation of what accounting does for us, of what an account collects. Because remember, it collects both the increases and the decreases. It collects both the credits and the debits in one place. So we'll come back just a little bit farther. And we're going to talk a little bit more about how we have account titles. So our account titles that would be in our journal entries, which we'll get to. And for our T accounts, they're not going to be phrases. It's not going to say paid cash. It's not going to say bought supplies, performed services, or things like that. Those are descriptions of events. Those are not the actual accounts. It will be the name of the asset, the liability, or the stockholder's equity itself. So it'll be common stock. It will be notes payable. It will be accounts receivable. This is what it would look like. You will have a chart of accounts that you will use. in most cases in your homework, or you will be given semi-clear account names. Every transaction in accounting will affect two or more accounts to the basic accounting equation, and it will keep it in balance. Recording is done by debiting at least one account and crediting another, but the value of the debits will always equal the credits. The term debit means left, and the term credit means right. They do not actually have a universal increase or decrease descriptor to them. Whether they increase or decrease an account depends entirely on what the effect is. So the act of entering an amount on the left side of a T account is called debiting. Making an entry to the right side of the T account is called crediting. When you take the totals of the two sides and they're compared, an account will have a debit balance if the left side total is greater than that of the right. And conversely, the account will have a credit balance if the totals on the right side of the account are greater than that of the left. So in this case, we have $18,000 in debits and $3,000 in credits. The total is greater on the left, so it has a debit balance. And that debit balance is the difference between the left and the right side total. Now, when we flip this and we look at $11,000 in credits, or right side, and $10,000 of debits on the left side, we know that this has a credit balance. And the difference is the amount between the credit and the debit. That is $1,000 credit balance. So here we are looking a little bit more at some of the procedures. You'll notice that there's a little bit of a cheat sheet here. A normal balance, which you'll notice that your front classification and chart of accounts information talks about what says a normal balance and whether it's a debit or credit. A normal balance is the side, so the left or the right, the debit or the credit side, where increases in the account are recorded. Now you'll notice that increases in assets are debits and increases in credits or increases in liabilities are credits. So when we are looking at an account, we expect that debits should exceed credits when we're looking at an asset, and that credits should exceed debits when we're looking at a liability. The two-sided effect of each transaction is recorded in the appropriate account. This helps to ensure the accuracy of the recorded amounts and helps us to detect errors. Now, looking at stockholders' equity, remember it is actually comprised of different elements that impact it. So the actual stock accounts themselves, common stock or owner's equity. It has a normal credit balance. Retained earnings themselves should have a normal credit balance. Investments by the stockholders, net income, and revenues increase or credit our stockholders' equity. Now, accounts such as dividends and expenses have an impact of decreasing stockholders' equity, so they have a normal debit balance. The effect of debits and credits on revenues and expense accounts is the same as their effect on the stockholders' equity. Revenues increase stockholders' equity, so normal balance or an increase would be a credit, whereas expenses reduce or decrease stockholders' equity. So their normal balance is a debit. Now, there is one little cheat sheet way that I can show you to kind of remember what is a normal balance for what type of an account. For an asset, a liability, a stockholder's equity, a revenue, or an expense. And I'm going to pull that up right now. So here you see we kind of have the hang loose sign with your hand. I want you to make this figure with your hand and look at it. Now I want you to go through your fingers left to right. Assets plus liabilities, assets equals liabilities plus stockholders' equity. That's the first three fingers. That's your balance sheet. Revenues minus expenses. That's your income statement. The fingers that are pointing up towards the sky increase with debits. Therefore, they have a normal debit balance. The fingers that point down increase with credits. Therefore, they have a normal credit balance. I will load this PDF to Canvas so that way you can save it and try to commit this to memory. It does make things a little bit quicker when you're working on something if you can go, it's an asset, it's up, it increases with a debit. Now continuing on, we will actually work on the elements of stockholders' equity relationships because it is the most complicated of any of our accounts and how they work, because we have things that go both positive and negative in these. So how this works, your stockholders' equity is comprised of two key elements on the balance sheet. That is your common stock, that is the actual investment by stockholders. So when a stockholder gives you cash, they're increasing their equity. Then we have retained earnings. Retained earnings represents net income that is still currently retained in the business. Those are the basic stockholders' equity accounts. However, retained earnings is complicated. Retained earnings is comprised of the impact, the net income of revenues and expenses, which then also flow to your retained earnings statement and takes into account the dividends on the retained earnings statement. This is a impact and a flow of information that you really do need to keep in mind. So you start with an income statement. What did we do for the period? What were our revenues? What were our expenses? What is the difference in those? We add that amount to our beginning retained earnings. We then reduce it by dividends to give us an ending retained earnings to report on the balance sheets. So if we were to have an investment of $10,000 in common stock, we would see $10,000 increase in assets and then $10,000 increase in common stock. Now we increase an asset by debiting it, and we increase common stock or stockholders' equity by crediting it. Our debits equal our credits. This is a quick visual to kind of show you how the normal balances of debit and credits work. Here we have a slightly different type of visual. Either one of these is more than welcome for you to screenshot and print. And that is, we increase assets and expenses. Remember the fingers that are up? With debits. It's normal balance. And liabilities, equities, and revenues will decrease with debits. And then we increase those liabilities, equities, and revenues with credits. And we decrease assets and expenses with credits. To illustrate using T accounts, we have here the basic accounting equation. Assets equals liabilities plus stockholders' equity. And then we expanded it utilizing T accounts. So assets equals liabilities plus common stock plus retained earnings plus revenues minus expenses minus dividends. You notice that the plus and minuses show you whether a debit will increase or decrease that particular type of account, depending upon what it is. The equation has to stay in balance after every transaction that occurs. So there will always be equal debits for credits. Let's take just a quick minute and look at a review question on debits. Do debits A increase both assets and liabilities? Do debits B decrease both assets and liabilities? Do debits C increase assets and decrease liabilities? Or do debits D decrease assets and increase liabilities? Why don't you just take a second and think about the hand sign. What increases with what? And if it increases with a debit, then it will decrease with a credit, and vice versa. So C, it increases assets and decreases liabilities. Now remember that a normal balance is the side of the T account that will increase that type of an account. So accounts that normally have debit balances are what? Is it assets, expenses, and revenues? Is it assets, expenses, and equity? Is it assets, liabilities, and dividends? Or is it assets, dividends, and expenses? Again, go back to your hand moment when we know it's assets and expenses both have normal debit balances. But equities have a normal credit balance, so we know it's not B. Revenues have a normal credit balance, so we know it's not A. We know that dividends decrease retained earnings. Therefore, they're going to have a normal debit balance, so it's D. We'll go ahead and in this particular lecture here, and we'll talk about the recording process next.